Okay, we have started recording and it's November 7th. I'm Tim Quast from Market Structure Edge. With me today is market strategist Brian Wilson, and he and I are we'll cover this live demo and discussion. We call it both. I mean, it's not really a demo in the sense that we take you through, specific one, two, three things about the platform. Happy to do that. But it's really a discussion about using the data effectively, and we try to put it in context. And boy, is this a consequential week to get together. As Jay Powell is speaking now. By the way, if it looks like I'm peering down at you, apologies. I'm on my backup device, which is a Microsoft Surface, because I pulled a boneheaded move and broke my power cord to my laptop. I've got one coming tomorrow morning, but so I have to use this device. It's works well for me, but it's not the best visual for you, and I realize that. So here's what we're going to do today. I've got three things roughly to cover. Simply, how long will the Trump trade last? Can we determine that in the data? We'll talk about that. How do you simply trade volatility? I'll explain some basic concepts around that I think should be helpful to you. And then number three, how to understand demand and supply and know what's coming. So there's no perfect thing to see all of these features, but we'll assert that Market Structure Edge is pretty good at this. It is to me the most effective way to see what all of the money is doing all the time, and to understand what the trends are. So with that, let me share my screen with you just a moment here. There we are. Okay. There. Wow, that's skipped a step. That's a little disconcerting. Okay, so there we go. You should see my screen. And if you're not familiar with Market Structure Edge, this is the Edge dashboard. And so if you logged into the platform, if you haven't done it, this is what it looks like. And right at the top are two very, very important things: the daily trading ideas, where we basically take the momentum and low volatility portfolios that you have here, and then we add entry and exit points, probabilities, and some various other data points. But it screens from these two groups, the ones that have better than the 50% probability. I mean, otherwise it's just a coin flip. And the whole point here is to move away from a coin flip in the stock market. I mean, how do you know whether something's going to go up or down? Market isn't driven by fundamentals or technicals. It's really driven, like any market, by supply and demand. And that's what we focus on. So these two things, these are all, each tile, of course, is a portfolio. And this is demand and this is supply. This is what we mean about looking at how supply and demand behave. These are very simplified views, but if five is the axis, do we have excess demand and is supply falling, or is it the reverse? And those are the core conditions that we want to look at. And how are we getting to these things? Well, we use trade execution data that we consume from stock exchanges, and we apply mathematics to that to normalize the way trades are handled and executed to a 10-point scale, so we can see whether there's more buying than selling, or vice versa, because algorithms are designed to deceive. The market is 98, 99% algorithmic. If you hit a button to buy or sell at your brokerage, I use Interactive Brokers, maybe use multiple ones. And there are only two kinds of trades: a marketable trade or a non-marketable trade. A non-marketable trade is outside the bid or offer. A marketable trade is within them. And a marketable trade, by law, must be automated, so it can move to wherever the best price is. And so algorithms manage the market, and you hit a button to trade a stock, it's an algorithm. And so that's math. And math is measurable. And so that we measure mathematical behavior in the markets. And because so much of it is mathematical, it's pretty measurable. We can see what's happening. So here's what we saw headed into the election, to get to point number one: the Trump trade, and how long will the Trump trade last? You could go back to September, and maybe even a little, here, this is, if you, I'm not sure how large this is on your screen. You can pop it out and make it a little larger if you're having trouble seeing it. But back in September, this trend of supply rising began to reverse, and it fell and it fell and it fell and it fell and it fell. I mean, that's a pretty good indicator right there that nobody wanted to be short the market. Well, you could say, well, is that like the betting markets, which proved quite accurate about the outcome of the election? Is it similar in the sense that the people looking at the market were also concluding, well, this is the direction things are going? I can't tell you that, but I can certainly tell you that this is a very long downtrend in supply. And so if demand remains strong at, 5 or better, and supply continues to decline, there's a high probability that the market rises. And that was certainly the condition right into the election. There was a little bit of shorting, a little recovery in the supply side, right into month-end options expirations. I traded volatility there, and I'll explain that. That's the next thing that I want to talk about. But then right away, supply fell off the cliff. This is quite low. I mean, if you look at the long-term averages in the market, particularly if you backed up a little period, it's close to 50%. Half the volume is long and half the volume is short. And that's what this is. This is Reg SHO Rule 201 data. And that's the modified uptick rule put in place by the SEC through Reg SHO in 2010, but 2011 it was implemented. And then FINRA oversees that. And FINRA is the one that articulates the rules that create this data set that we can consume and track called short volume, not short interest. Short interest is a 1974 measure created by the Fed to track the use of margin accounts as part of the money supply, because we left the gold standard in 1971. And volatility exploded in interest rates and currencies, and people were hedging that exposure. And so we started tracking margin account use. And that's where short interest comes from. To me, that is not a useful measure. Short volume is a very useful measure because it's the grease of the skids of the market. It's the way trades get filled. I mean, more often than not, a trade, if you buy something, you're probably buying created stock. And then a market maker will have to go cover that and equalize the books at some point. Market structure is complicated, but that's pretty easy to see. And so and then demand, that's that 10-point scale. The market tends to trade between the red line and the green line. So as we were heading into the election, demand bottomed. I mean, it actually ticked down another notch, but 2 days at the same place is what we call a bottom. And so ahead of the election, by November 1st, you get to the 4th and we're at a bottom and supply has dropped sharply. That's a pretty bullish signal. It would say that there's a high probability that the market rises. Now, would it have been different if Kamala Harris had won? I don't know. Those are, they're counterfactuals. We don't know what the outcome would be, but there's certainly a bullish posture in the market. The trouble is you don't know what's going to happen. That's why we talk about broad sentiment. This is broad sentiment right here. Is what's happening with supply and demand in the broad market. Context. What kind of things could unexpectedly alter outcomes, like options expirations? Those are those little green things you see there. We track those because they're so often turning points in the market. They create volatility. The month-end options expirations, the 31st, big volatility trade right there. We could have a very high probability knowledge that was going to happen, and you can trade that. And then divergence. You're looking for these things to separate. So how long might this Trump trade last? If you looked at this data, could you conclude anything about how long it will last? Well, you could back up and get some pretty good indicators. I'm going to do that with an image. So this is that same chart backed up to the maximum of the data set, which is July 1, 2017. Why? Because that's when the exchanges started providing data that we could use to track this. We've done it a long time. We've done it since 2005 when Reg NMS was implemented in the US stock market, but we had to do it for public companies with data sets that they receive. And in 2017, suddenly there was a public data set, and we said, oh, now we can build a platform where we could track all of the data, not just a limited data set. So that's why it goes back to this point in time. Wish it went back further, but on the other hand, it's not that material. The size of the data set isn't what matters. It's the apples to apples comparison, very much like a political poll. Why do pollsters have such a difficult time pegging outcomes? because they don't have a good apples to apples comparison. If people's behavior, the way they absorb information, their willingness to respond to a survey, how they do those things keeps changing, well, how do you get an apples to apples comparison? Well, this is apples to apples data, but the behavior changes. More and more money is passive, less and less and less of it is stock picking. There's more speculation, there's more intermediation. So we measure in shorter periods because we want the best probability of understanding what's happening at point A in time versus point B in time with the best comparatives possible. But having qualified that way, let's look all the way back. Here's what you could know. Here's where we are right now. That steep drop on the supply side is what we're looking at. Well, could you find that happening other times? Well, it happened here, a little briefer, but certainly here. This back in, ahead of the pandemic, there was a steep decline on the supply side, then a sudden explosion on the supply side. As an event, the pandemic rocked the market, and we had the steepest bottom in the entire data set was right there. So if you were trading then, you could look at that and say, well, it dropped to 1.8 or something like that. Wow. On a 10-point scale. And you'd say, well, that's a huge bottom. I put a bunch of money into the market there because of that. It was a clear indication that no matter what happened, that is a market bottom. You could see it as plain as day. You could back up to 2017, 2018. There was a monetary policy event that happened here. The dollar suddenly strengthened. Heading into that, there was a steep drop in supply. Then it exploded. That was a market bottom too. Big move in the market right there. And then the market took off. Same here. Market took off. So what happens here? Well, I don't know. There's no crystal ball in that data. But if there is something, could you say, well, the election, the markets would consider it a very positive thing because Trump policies are likely to be more market friendly. So are we off to the races, or is there something coming? I don't know. I can't tell you absolutely. But if there is something that the market reacts to, these conditions tend to precede a correction. Again, I'm not saying there's a correction coming. I'm saying that there is a probability. What if the December jobs number is minus 400,000? I'm just saying, could that happen? Well, it could. I don't know. I can look at the data and see that the jobs data deteriorated. If you look at not the establishment data where we had 12,000 jobs in the most recent report last Friday. If you look at the household number, it was minus 368,000. Well, I don't know. Does that data show up and did that rock the market? And do we have a correction and a sharp jump in supply? And then the market does well. I don't know. But to me, this is the risk in thinking that the Trump trade is going to run. It might. I won't say that this is an immediate thing. If you went back and looked at the amount of time that this takes, this could be a month. Could be. But I look at these, and I've said this now 2 or 3 times, that I think that there's a very significant risk of a correction simply because the conditions that are present that can create one of those. If you look at the supply or the demand side, there's also deteriorating demand. Now, maybe this turn will change all these data, and all of a sudden we're back to a very strong. See, when you have a lot of green and it's spending a lot of time above 5, that creates strong markets. When it deteriorates and it starts to break down and we're not getting back to 5, that's when markets decline. And we had a really strong period of demand here, and now it's deteriorated. Now, maybe the Trump election will change that and restore a very strong demand trend. If not, a bad data point will create a correction. I'm just saying I'm going to be very careful about that. It's not I'm going to go plow a bunch more money into the market here. I will focus on shorter term trading and less overall exposure because I don't know what's coming, but I don't think that these are great. Now, we'll look at how the data go and how they improve or don't. But that to me is pretty important to understand. Now, back to this volatility trade. I want to explain that briefly because I don't want to take all of Brian's time. But I was in Spain last week and I traded there. I would buy positions 7 minutes before the close, give or take. Why then? Well, it's right into you're going to get a pretty stable price because all the money that wants a reference price kind of the midpoint, an average, a time weighted, a volume weighted, pegged average is going to be doing that into the close. So it's a good time to buy positions. I would buy, say, SQQQ, a leveraged short tech position, TQQQ, a leveraged long tech position, so that whatever the market does, I'm covered, right? I can drop one side or the other, and then a volatility trade, UVXY. Why would I do that? Well, because demand was falling and supply was rising and options were expiring. What was the probability that there would be volatility there? Exceedingly high. And I knew which direction. So then it was very easy, and Brian did the same thing. It was very easy to produce very low risk 2% returns every day there, right? And then I would buy the position, and then at the open, within 4 minutes, I'd be out of my position, take my 2%, and go run around Barcelona. And I didn't have to think about my positions because I knew exactly what the data were telling me was going to happen, because I understood broad sentiment, context, options expiring, and divergence, or in this case, convergence. I knew that the market was probably decline, but would certainly give me volatility. And so those are things you can always use. It takes time, you practice and you get comfortable with the data, but that's how to do it. It's not that, it's not that I can do it. So it can't be that hard, right? So now, last thing, and then I'll hand it over to Brian, is to take this around to understanding supply and demand, because this is how you can see what's going to happen in the markets. If you want to know what's going to happen with AI, you can build a portfolio with stocks that are exposed to AI. And like so much of the market, you could really see this. I wrote about this Monday, that into options expirations in October, pick your portfolio, say about the 20th, October 20th. The period spans about a week. But what happened? Demand started to fall and supply rose. This is where large institutions reduced their exposure to the equity market. You could see it everywhere. There's that supply bump, supply bump, supply bump. Every portfolio, exception of maybe airlines and cruise ships, where it didn't have quite the same thing, you could see it everywhere. Well, then you could know, right? If tech demand softens and supply rises, people are reducing their exposure. And now it can change very quickly, but that was evident everywhere. And you can see those things. What is it now? Well, I mean, just look how low supply has gotten. The good news is supply is very low and demand is pretty stable. That tends to be good for equities. The bad news is supply is so low and has been so low for so long that some unexpected event could reverse that. That's the thing to know. And so, to me, you have to be careful if your longer range exposure to things, no matter how good you might think it is, you should be flavored with some caution because of that possibility. But there's always opportunity to trade supply demand divergences. Okay, that covers what I wanted to cover. Brian, maybe we can tag team about the what's next, but I've kind of said my thinking on what's next. So I will hand it over to you, Brian.
Sure. I'll circle back to you for a second, Tim. You were mentioning a volatility trade when it was in a state of convergence. Could you perhaps share your screen again and maybe just give us a fictitious example of what something like that would look like?
Sure. So, again, this is what real time, this is what I did. And you could do and you said, well, where's the divergence, right? You could do it either way. So here, for instance, if you come out of options, if right through options expirations, there's, you got rising demand and falling supply, maybe that's not even a great point in time because you very quickly topped here. But let's expand it out and we'll talk about a divergence and a convergence. This period right here, let me just do that. Here's convergence. Demand is where my cursor is falling and supply is rising. There I'm going to be short. So when I had the long short positions, my short position a little larger, 20% larger, because I think that's the bias in the market, but I'm trading volatility. Right. So then the opposite would be divergence, and let's span out 3 months, and maybe we'll have a good example because I do this all the time. Here's a good example. Right here, you have rising demand out of options expirations and flat supply. It's pretty high at 50%, but you know that divergence, more demand than supply, likely to produce gains in the market. And again, we're only after 1 to 5 days. Take 2%. I think of this very much like return on capital. It's like an internal rate of return. Not I'm doing a bunch of research to try to figure out something that is going has accelerating earnings or widening margins or whatever, and that is going to translate into gains. It may or may not. That's not how the market works. BlackRock does not buy accelerating earnings. BlackRock buys a product called equities, and it needs whatever the percentage is in whatever portfolio it is. And they don't want volatility because that causes tracking errors. So you have to realize they're buying products, not stories. And so, you want to find good divergences to go long like that. And the volatility rule is SPY moves about 1% a day. Stocks comprising it move about 2% a day. That's our target. Momentum stocks move about 3% a day. You could go look that up with NVIDIA and you'll see it. So I don't know if that answered the question, but hopefully it shed a little light.
Oh, thank you. And just as a reminder, feel free to send an email to myself, to Tim, to Henry. We're always available for your questions, and happy to get together with you individually as well. So just let us know on that. Tim has covered already. Thank you, Tim. That was excellent. Most of what I wanted to talk about. I will circle back to that short volume topic for a moment. Because it's fascinating. I mentioned it this morning that there was basically no comparison, and really there isn't. We take it back to similar look that Tim was showing you, and here's what I'm looking at. If you look at short volume here in early September, it was roughly 51%. It's moved down to 46%, essentially about a 10% move lower in the space of about 2 months. And if you look back, going back to 2017, when do we last see similar circumstances? It's hard to find it. It really is. If you look perhaps in here, this was October 2021. Short volumes moved down actually lower than where we're at right now. But you can see short volumes were already low at that point. So here we're moving from a high short volume environment down to a low one. And really, when I was looking at this, the only comparables I could find, you had to move back to COVID.
Yeah.
So obviously, COVID declines here. Short volumes were high for a period of time. We had significant short covering. And this was fascinating. I'm not saying this is going to happen, but look at what happened after we had that short covering. We had just an incredible period where short volume stayed exceedingly low, and the whole market rallied out of COVID. Obviously, a very different time right now. But you look historically. When do we see similar circumstances? Well, coming out of COVID. We had one back in 2021, right around in here as well. This was towards the end of a bull run. One argument you could make, well, this was the beginning of a bull run. This was the end of a bull run. Which one is it right now? No, no clue. No clue. What we do know is that you can see it very clearly. It's an outlier. And whenever there's outliers, it catches our attention. What's going on in the market. And to the point that Tim made earlier, you can see the effect that low short volumes have had on the market here over the course of the last couple of months. Now, nothing is going to go straight up, parabolic, but over the course of the last 2 months, short volumes have dropped by 10%. What effect is that going to have on equities generally? Well, equities are generally going to rise. And of course, we watch out from a context perspective. We watch out for expirations. We watch out for month end. And I think we provided, ample dialogue around those events. But just be aware that we're watching this short volume trend right now because it is an outlier. And you could make an argument, either way, which way we go from here. I think to Tim's point, it's probably more likely that it's more of a market top than a bottom with more room to run. But here's a bottom. look at the upside afterwards, and here was essentially a top, moving into a bear market. So once again, just
And,
be aware
and I might
that,
interject really quickly too,
yeah,
Brian, to your
yep,
to your point there. That you could say, well, why wouldn't we just duplicate that again? Keep in mind that at that beginning of that point, that's we had massive infusions of capital from
yep,
pandemic stimulus, and so no one was going to short that. There was no way that you could short that market, and so you have that very prolonged period of low short volume, well below trend. That's what we mean. If you look at the
yep,
trend. Um, and then it ended. What's fascinating is how it ended. So Brian, if you go over to like February, yeah, right in there,
yeah,
it ended because the market was ahead of the Fed. That was the end of the rate cutting cycle. That's what it was. So it,
hmm,
the and so instantly the market reflected that, right? So it's and then the end of the whatever you want to call it, the hiking cycle happened in at
yeah,
October 31st 23, and you can see what happened. So that right there where Brian's cursor is, we had a massive surge in demand, that big green part of the graph, and supply it really tailed off. You have to zoom in on that, but it also dropped about 10% there, believe it or not.
hmm,
And so
yeah,
the market gives you a very good indication by its behavior, its demand supply behavior, how it views things like pandemic stimulus, the end of rate cutting, the end of the hiking cycle. All of that shows up very helpfully in the supply demand data. Sorry, Brian.
hmm. No, you're fine. I appreciate the interjection there. That's great. Just a reminder, and I'll come back to a normal view here. We're coming up on options expirations next week. We would say that generally market participants are pretty bullish right now. So, here was the last cycle in October. We're at higher price points currently. We're presently zooming along. Just be aware, though, that at some point, and I wrote about it this morning, the closer you get to expirations, sometimes you have opportunities. I don't know if it will turn out that way this time or not. And what I mean by opportunities, you're getting the time decay in terms of the options. And if the market is higher going into expirations, sometimes there's an opportunity to pick up inexpensive, in this case, let's say put contracts. Put contracts would be on sale. You could pick them up for pennies on the dollar. You don't even have to hold them that long if you get them directionally correct, and you can make a nice profit in a short amount of time. What happens to stocks like DJT, that have excessive volatility on a given day. That thing was up, I think, 30% yesterday. By the end of the day, it was up 6%. So you get, especially with very volatile stocks, you can start to see some of those types of moves here during the next few days. I think the bias is to the upside into expirations, but just be aware that with individual names, especially with those types of gains, what was it, 3.5, 3.75, I think, in 2 days. With these types of gains, you're going to get some profit taking or market participants taking the other side of the trade. So just be aware in some of the individual names here over the next few days. We might start to get some of that action. I briefly talked about this concept this morning. I don't know if it has any merit or not. It's a little strange to me right now. It's what's occurring in big tech. So as the market is zooming higher, big tech sentiment is not tagging along. Now, today we are getting some follow through, markets up 80 basis points right now. And here's the big tech components. Everything's pretty good right now. So maybe that's just a little bit of a false outlier. I'm not sure. But that caught my attention when I was looking at the data this morning. I'm like, that just doesn't seem right. Because as we know, it takes big tech to be moving higher for the market to be able to hold on to gains. So if we want to hold on to these Trump trade gains, I think we'll need some participation from big tech. We're getting it today, so far so good. Maybe this evens out here before it moves below neutral. but it was just something that caught my eye this morning. And I mentioned expirations already. I've moved back into trading from our daily trading ideas. Picked up Twilio this morning, in and out of the name already today. So the daily trading ideas continue to work. Momentum names are increasing once again. 12 names in the momentum portfolio this morning. So we're getting some opportunities there. So I think that was everything that I had. Let me see if there's anything else from a what's ahead perspective. I'll go back to broad market sentiment. If we, and maybe we can comment on this together, Tim. Once again, here's that move lower in short volumes, 10% move lower in the course of 2 months. Very much an outlier right now. Uh, do we fully bottom here and move higher? I'm not sure. It's a slow move higher, relative to the gains that we've had the last couple of days. So I think we're in a little bit of a tricky environment. We're not getting the demand thrust higher that I would anticipate with these types of market gains, and short volume is an outlier. So we're at a place where I think we could really go either direction. And I'm not being not being very good in terms of
Being
making a
an
prediction
economist
there.
on the one hand and on the other. What
Exactly.
wasn't it Harry Truman who said he wanted a one-handed economist because they always were saying on the one hand and on the other. Anyway, uh,
Right.
no, I agree with that observation. And look, the supply and demand are meant to be predictive and they're averaged. So that demand scale, you'd say, well, how is it that the market could pop and yet demand sort of tails down? Because it is a rolling 5 day average. Why is it a 5 day average? Because all through the market, the patterns of movement by institutions tend to hew to a 5 day manifestation. There are always exceptions. In fact, we use it in our corporate business for public companies to identify activism and deal arbitrage because they diverge from these very observable passive patterns. So it did what it was supposed to do. It told us that the demand had bottomed and supply declined. Well, what does that tend to produce? It tends to produce rising markets. Now we'll see if the market's very volatile, and if it for some reason were to give back the enormous gains that we saw in response to the elections outcome, we might stall at 5. But it's probable, as Brian said, it's probable that we get back on a rising demand scale and that we go right back up over 6. That would be my expectation too. But it may happen right into November options expirations, and beware of that. If that happens, if we're over 6 into options expirations, which would be the end of next week, right? I haven't looked at the calendar actually to see if it's
Mhm.
split, but I think that's right.
Yeah.
Then beware. Beware. It's been a long time since we had a real entry point in the market. And as in anything, an economy, the stock market, Nvidia's chips, Supermicro. I mean, look at Supermicro. It was the best performing stock last year, number one or number two, right? And now it's down 80%. So things change, and if you don't have a reset, markets need it, economies need it, and we haven't had a big drop below that green line 4.0 since April. And sooner or later, that's going to happen. It doesn't mean it can't continue on. This is not the longest time in the data set that we've gone without an entry point like that, but it's a long time. And it tells you that
Mhm.
the odds are increasing that that's going to happen at some point.
One quick thought, Tim, just with
Yeah.
expirations next week, it is a split expirations, and what we
Okay.
mean by
That's what I was
that
thinking.
is expirations will be next Thursday and Friday, and then we'll fast forward to the following Wednesday for volatility expirations.
Yeah, let me just show you that really quickly. Here's what we mean. You can do this. Just go to Market Structure Edge. Then go up here under resources, and there's the 24. We even got the 25 out there, so you can look ahead. And this is what we're talking about. So in November, it's split. So 14th and 15th, this will be index options expirations, triple witching. And then the following Wednesday on the 20th are VIX expirations. So that whole period is really expirations. And new options will trade on the 18th. And counterparties are going to try to square the books, and they won't even be able to fully close the books because they'll still have exposure to VIX securities the following day. But all of that can be a volatile period. We always look at that. Where's demand and supply going into those? If demand tops into those, the market has a high propensity to fall afterward, and vice versa. So we always watch those things. And people don't pay enough attention to the significance of derivatives in the market, but we do. It's very important stuff to know. Okay. We have consumed all of our time, haven't we? All right. Well, we'll call it good for this week then, and we'll see you next week. Thanks for joining.
That's good. Have a good day, everyone.